Every trader knows the volatility that comes with major news events like NFP, FOMC, CPI. But do you really understand how smart money manipulates liquidity during these news events? If you have been caught in stop horns, fake breakouts, and aggressive price moves, then this video will show you how institutions exploit liquidity zones and how you can position yourself for high probability trades. So let's break it down. So what happens during news events? When high impact news is released, retail traders react based on sentiment. Institutions and market makers engineer liquidity traps to fuel their orders. Stop horns occurs to grab liquidity above resistance and below support level even before the real move begins. So smart money manipulates liquidity during news events. These events create predictable price inefficiencies, and this market moves aggressively because smart money needs liquidity to execute large orders. So liquidity sweeps allow big players to enter positions at premium or discount prices. How do you trade along with smart money, or how do you detect these traps in order to be on the safe side of the market? First thing you will want to do is to go to your economic calendar and note the major news impacts that are likely to occur during those days. When you acknowledge them, then you will move on to your chart, move on to your higher time frame, and try to know where the market is actually heading on the higher time frame. Your higher time frame bias is very, very important. Where the nearest place price is reaching out to, or the draw on liquidity on the higher time frame, will give you a perspective of where the price is actually going on the long run. So when you note your higher time frame bias, when you're able to frame this your bias, you will switch to your medium time frame, assuming you are using 3 major time frames. Let's say 4 hours as your bigger time frame, 15 minutes as your medium time frame, and 1 minute as your entry time frame. You can look for your directional bias on the bigger time frame like the 4 hour. Then when you switch to the 15 minutes, you can plot your range, get the range, and you use the 1 minute to frame your entry. Let's take for example, in this chart we have our news that is coming up on 8:30 EST. What we do after noting our major news impact is to go to our higher time frame to frame our bias from there. We go to the 4-hour chart. This is the 4-hour chart. As you can see, price has been on a decline here recently, and we have price take this liquidity around this area, and we have a smart money reversal, and we see price started to move up. So where is price reaching out to? Price is reaching out to few inefficiency on this bigger time frame. So we have an inefficiency here. We have an inefficiency here. This is the area where we are trading our Newsday. This is our Newsday area here. So price is reaching out to the inefficiency there. And when price reaches out to this inefficiency, we will likely see a drop in price. So what are we going to do? So we still have another bullish fair value gap below our news area. So when we note all these things, so we know that price is reaching out to this fair value gap. So when price mitigate this fair value gap, then we will trade possibly lower into this fair value gap below here. So we will go to the 15 minutes to mark our zones. So this is the 15 minutes. As you can see, we are in a period of consolidation from this price range to this price range. So during this period, we have traders placing their orders, stop orders, buy stop, sell stop orders above and below all this price range. And when that happens, smart money is trapping traders into taking the wrong positions in the market. So immediately after this news event on 8:30, you see smart money push price and push it into this PDRA on the higher time frame. This is a smart money trap in order to trap breaker traders into taking the wrong position in the market. So that is why it's very, very important for you to know the directional bias on the bigger time frame, where the bigger time frame is actually going to head to. So when smart money push price to this level, we have breaker traders who have been trapped into this level. You see price quickly reverse, feeding up the inefficiency and take the stop loss orders of traders who have been tried, and price money push price down into this fair value gap here. So these actions is very, very predictable if you are always looking at your higher time frame bias. So price will always gravitate to the higher time frame bias. So let's look at another example of this. This is another example. As you can see here, we have a major news event that came up around 8:30 here, and before then we have price swept this area. We have a manipulation here, and price moves to the upside. So before this news event, there was already a manipulation here. So when looking at these charts, do we have a clear direction of where price is going? No, we don't. That is why we need to look at our bigger time frame to tell us more information, to give us more information where this price is actually heading to, so that we can position ourselves in a right place to enter this trade. As you can see on the 4-hour, we have price moving up in a bullish direction, and then we have a smart money reversal here, a liquidity sweep, and a smart money reversal here. What is our confirmation? We have price, we have a change in state of delivery here, and we have price move down to disrespect this bullish fair value gap here. You can see as price run through this bullish fair value gap here to this area. When price run through this bullish fair value gap here, we have price moving up into that fair value gap. We have a bearish fair value gap here. All this occurs before this price move. So what is our directional bias? Our directional bias is now bearish. Price has disrespected a PDRA, so we are looking for price to possibly reach out to the next draw on liquidity, which is the external low of the bigger time frame. So we have our external low at this range. So this will be our draw on liquidity on the higher time frame. So our news range is happening at this area. So what do we look at? We are looking for price to either return to this inverse fair value gap or mitigate this bearish fair value gap. Then we can trade from there. So we switch back to our 15 minutes to know what is going to actually play on in the market. So all this happens before the major news release. As you can see here, before then we have a manipulation here. We have traders who have breakout traders who may have been trapped thinking that the market will continue bearish from this point. We had a reversal to this area before this news release. Immediately we have this new release, we have a spike in this market to the upside. And what happens is that during this spike, price broke above this level, taking liquidity that is placed here and trapping breakout traders, and we have price pull down to take all those stop orders, and this is a smart money move. So how do we position ourselves to trade this? First of all, we have drawn our bias to be bearish. Secondly, we have price take liquidity here, and we have price then move into a PD array of a higher time frame. When all this thing happens, I will switch to my lower time frame to frame my entry from there. So this is my entry time frame on the 1 minute. So if I want to enter this trade, I would like price to disrespect this bullish fair value gap. When price disrespects this fair value gap, then I will enter on the inverse of this fair value gap. So we have a bullish fair value gap here. Inside this bullish fair value gap, price came, disrespected this bullish fair value gap. So when this thing happen, I would like price to come and probably sweep any of this high here, so that from there I can frame my entry and take trade. So these are my levels on the 1 minute chart. As you can see, I'm waiting for price to run through these highs. I'll wait for price to run through this high before I make my entry. So when price, as you can see on this first level, price came and run through this high first. We have a sweep here and we see price moving down. So why didn't I take this trade? Because I don't have a clear entry point from here. I did not see a bullish fair value gap here, because I would like to see price sweep this area with momentum. So there is no bullish fair value gap I'm seeing here that will confirm my entry. So I have to wait to see a bullish price that sweep this level with big momentum. Price came to this area and we have a sweep here. We have a long bullish fair value gap that sweep price with heavy momentum. So I would like price to disrespect this fair value gap here before I take my trade. As you can see, price broke down and disrespected this fair value gap and move up. What did price do? When price moves up, it closes above the inverse of that fair value gap, pushing price higher. When this thing happens, when this occurs, though this is a sign that this price will continue going downwards. As you can see, after the closure of this long bullish candle, we have another down closure candle. Then we still have another candle appears, still closes below the wick of that candle. The next candle still closes inside the range of this previous candle. So the market is really struggling to go bullish. But if I'm going to be conservative in trading, I have another bullish fair value gap that was created here. So I'll wait for price to again run through this fair value gap before making my trade. Price came down here and run through this fair value gap here. When price run through that fair value gap, you see price push back into that fair value gap and price rejected it. So this is where I place my entry from here. So this is a 1:2, or you can target your 15 minutes draw on liquidity. We are waiting for price to move down to the PD array on the 4-hour, which is the fair value gap on the 4-hour. That is our overall draw on liquidity. So you can keep, if you want to scale, you can keep taking trades to possibly when you reach that 4-hour fair value gap. So one point to note in all these things is, number one is to look for your economic calendar. Number two is to move to your higher time frame to frame your buyers. Note where the trend is actually going in the 4-hour. Then move to your medium time frame. Look for a range in price. If you see a consolidation before a major news event, look for the nearest PD array on the bigger time frame. That is where smart money are likely to push price to. Smart money are likely to push price to that level, trap traders, then either buy or sell from that level. So when you see that happens, always trade along the side of the smart money. So that is how you can frame your trade. Do not take trade out of sentiment. Do not enter the trade because you see a long move that is happening in the market. It is better not to trade than to enter in a wrong position out of sentiment. So that is how you can make a high probability trade, trading the news, trading during news session and using that to your advantage. Use events like NFP, FOMC, and CPI don't have to be a gamble. If you master liquidity concepts, you can trade these events with confidence. So drop your comments below if you have been caught in a stop hunt before, and let's discuss how to avoid it next time. Don't forget to like, subscribe, and turn on the notification button for more trading insights. Thank you so much.